and welcome to our year-ender series, Outlook 2025. We're going to ask a bunch of economists how the year ahead is going to pan out. It's going to be a tough task for all of them, with President Trump taking on, starting his innings on Jan 20th with the promises of a lot of high tariff barriers. But we have three economists lined up for us. First, Sajjid Chinoy of JPMorgan will be joining us, and thereafter we're going to be joined by two economists from the rating agencies, Dr. Devendra Pant from India Ratings and Aditi Nair of ICRA. But first, Sajjid is here with us. He's also, of course, a member of the Prime Minister's Economic Advisory Council. Sajjid, thank you very much for your time. First, draw up the global backdrop for us. I know it's tough, but the Fed has just told us that the number of rate cuts are not likely to be 4, but 2. Tell us, will global be a headwind or a tailwind for us?
I think we should be prepared for quite a treacherous global environment in 2025 because there are two distinct and potentially reinforcing shocks in play. And I think it's important to disentangle both of them. The first one, which occurred with the Fed this week, really should not be a surprise for those of us who've been watching the US economy quite closely. The premise that the Fed would cut meaningfully in 2025 was based on the fact that the US economy would slow and inflation would head towards its 2% target. But what we've been seeing all year long is this remarkable US resilience. Despite monetary policy being tighter by historical standards, the US economy, even in the fourth quarter, is still growing at 3%. So forget recession, we're at 3% growth in the fourth quarter. And this has been a story all year long, propelled by a very resilient US consumer. Now, what that's meant is that the last mile of disinflation is getting much more difficult for the Fed. The fact is, if you look at the last 3 or 4 months and you look at the momentum of core inflation in the US, it's actually running at an annualized rate of 3.5%. So we're very far away from 2%. So it was no surprise that having engineered the first 100 basis points of rate cuts, I think the first 100 basis points was non-controversial given how elevated starting points were. For US policy to go from 5.5 to 4.5, was not controversial. Now, beyond that, the Fed will have to move much more cautiously for 2 reasons. One is, as the Fed chairman said, there's so much uncertainty, and we've talked about the Trump administration, that when you're driving on a foggy evening, you want to go slowly. But secondly, given what's happened in the US economy, there's uncertainty now about the neutral rate. There used to be a belief that the US neutral rate was at 2.5%. The Fed has slowly been marking that up towards 3. I won't be surprised if that neutral rate is much higher than that. So for both these reasons, the Fed has the space to ease much less in 2025. Now, related to this is the Trump tariffs, because if you do get Trump tariffs, what the risk is that you will reinforce some of these dynamics. 2 big parts of the economic agenda for the new president is A, tariffs, and B, slowing the pace of immigration or resulting in deportation. And the dirty little secret is that high levels of immigration have allowed the US to grow at these levels and kept some lead on inflation. If you were to simultaneously slow the pace of immigration and put on tariffs, that is an adverse supply shock, which will push up inflationary pressures even more and will hurt growth. Of course, the US is hoping, equity markets are excited for the most part, because they believe, at least in the US, these 2 adverse supply shocks will be offset by deregulation and easier fiscal policy. The bottom line is there is uncertainty which could push up inflation further next year. We saw that in some of the forecasts of the FOMC members, and therefore the Fed has to move closely. What all of this means, and I'll end with this, is that the US exceptionalism that we've seen in 2024, higher growth, stickier inflation, therefore higher rates, that could get reinforced in 2025 by some of President Trump's policies. And that's why the dollar today is at a 2-year high. And that's why bond yields have backed up again.
Okay. Well, let me straight away come to India and, time permitting, go back to some of the global issues. See, we had almost started penciling in a rate cut from the Reserve Bank in February. But now with the dollar getting so strong, likelihood of say the rupee at 85.50 or 85.30, imported inflation, and the fact that the Fed may not cut very soon in the first half of 2025, does the hope of a rate cut from the Reserve Bank fade?
So I think, having tight global financial conditions affects all emerging markets, some more than less. I would argue India is impacted relatively less because we still have very high external buffers. And I keep going back to the point that the India-US policy rate differential back in 2018 used to be 500 basis points. Indian policy rates were 5 percentage points above the US. That narrowed at its bottom all the way to 1 percentage point. And that's another way of saying India did not have to hike in lockstep with the Fed. We had bought ourselves some independent monetary policy because of the quantum of reserves. So just because the Fed is cutting less doesn't preclude the RBI from cutting. I think what will matter more from India's perspective is what's happening with inflation. We're still expecting December CPI to be sticky at 5.5%. So two things will matter going forward through the first quarter. Are we going to see food inflation roll off? That's the hope, given that we've had a strong Kharif harvest, and Rabi should be strong as well. Hopefully food inflation rolls off. And the second is the point that you made, that I think it's important, if the dollar is stronger and all exchange rates are depreciating, that India's exchange rate does not become uncompetitive. I hope at some point we'll talk about India-China. So if the exchange rate has to become the shock absorber, which it must in some circumstances, there'll be some imported inflation. The good news is we're starting off core inflation at a low level at about 3.5%, 3.6% has been the average over the last year. So hopefully we can absorb some currency depreciation and imported inflation and still have inflation in the 4 handle in the coming months. So there are a lot of ifs in that statement, but if you do in a situation where inflation is in the 4 handle, I think monetary policy will have some space to move in 2025, given the quantum of external buffers India still has. So you use the FX intervention on the dollar front, and you use interest rates to handle domestic conditions, and therefore you've got 2 instruments for 2 objectives.
No, I take your point that the Reserve Bank has always maintained that it's not going to use the interest rate instrument for external reasons or triggers. But nevertheless, you haven't answered my question on what's the space available to Reserve Bank. As you see inflation, the nowcast numbers are still looking strong. As you said, 5.5 for December. So is February even live?
I think February is live because the central bank will have to be forward-looking. And the expectation is that Jan, February, March, given how food prices are expected to evolve later in December and January, should be below 5%. So by the February meeting, the RBI will have a much better sense of how food inflation is evolving and what the quantum of this imported inflation is. The RBI's own estimates are about 5% of rupee depreciation adds about 35 basis points to headline CPI over multiple quarters. So I think in February, the central bank believes that inflation is going to be in the 4 handle. I think February is still live, barring more shocks, because I do think we have to also be mindful that we have seen a cyclical slowing in growth, and it's uncertain to the extent to which the economy recovers. So with fiscal policy tightening, monetary policy, given where real rates are, may have to step in and offer some support next year.
Okay. Well, that brings me straight away to the growth question as well. We've got the scare of the second quarter, 5.4, which, of course, the CEA says could be revised higher. Be that as it may, what's your forecast for the current year itself, current fiscal, I mean, and next year? Are you seeing some meaningful slowdown for both domestic and global reasons?
So we're working with a number of about 6.4 or thereabouts for this fiscal year, which entails a meaningful payback in the second half. But I think it's important to distinguish how much of that payback is because of a very strong agricultural harvest and strong government spending, and therefore controlling for that, what is the underlying business cycle doing? How is core GVA evolving? I think that will be a better signal on where the private sector is and therefore what the outlook for next year is, under the assumption that we have a trade war next year and the US will, we take the president at its word, you put on 60% tariffs or close to that on China. Our China economists have next year's growth below 4%, right? Between 3.5% and 4%, despite the fact that China will do more fiscal, more monetary, and will depreciate the exchange rate meaningfully. Now, the reason this matters for India is what are the channels by which India gets impacted by a trade war? The first channel, which is exports to China, are much less in the case of India compared to a Vietnam or a Singapore or Taiwan. So we don't have to worry about the export angle. We have to be far more vigilant on the imports angle, because what we've seen in the last 3-4 years is a lot of Chinese excess capacity has found itself into many Asian economies, Indonesia, Thailand, India. Now, if the US were to put on tariffs, even more of this excess capacity can be expected to be directed to Asia. And at a time where India would like to see a corporate investment cycle, if you have even more Chinese imports coming in and it's hard to compete with them given the excess capacity they have, then corporates need even more demand visibility going forward to make large investments, especially if the global environment is uncertain. We should be prepared that it's a world in 25 where you could see more global uncertainty, you could see much lower Chinese growth, you could see more imports from China.
Thank you very much for that, Sajjid. Wish you a brilliant 2025. We have to go into a break. Thereafter, we are going to be joined by Aditi Nair of ICRA and Dr. Devendra Pant of India Ratings.